In this video, we're going to explore 5 monthly dividend stocks that you can buy today to generate passive income from your investment portfolio. Before we begin, I invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. With that out of the way, let's dig into these monthly dividend stocks that you can buy today. Monthly dividend stocks are securities that pay out a dividend every month instead of quarterly or annually. More frequent dividend payments means a smoother income stream for investors. Additionally, monthly dividend stocks are better under all circumstances, everything else being equal, because they allow for returns to be compounded on a more frequent basis. More frequent compounding results in better total returns, particularly over long periods of time. Finally, monthly dividend stocks allow investors to have, on average, more cash on hand to make opportunistic purchases. Having cash isn't often important, but when it is important, it is really important. As a result, investing in high-yield monthly dividend stocks is a great way to begin creating a monthly passive income stream from your investment portfolio. Here are the 5 most attractively priced monthly dividend stocks today. The first is APLE Hospitality REIT. APLE Hospitality REIT is a $3.7 billion hotel REIT that owns a portfolio of 241 hotels with more than 30,800 rooms located in 88 markets in 34 states. It franchises its properties out to leading brands, including 114 Marriott-branded hotels, 126 Hilton-branded hotels, and 1 Hyatt-branded hotel. APLE Hospitality REIT was formed in 2007 and has sustained or grown its dividend every year beginning in 2015. APLE Hospitality REIT is one of the most attractive plays in the hotel sector due to its strong brand power, very conservative balance sheet, and attractive, well-covered dividend. While the slowing outlook for the economy and hotel sector make it fairly risky, its 9.2% total return outlook, comprised of a 7.4% dividend yield and 1.8% projected share price appreciation, make it attractive for income investors today. Next up is STAG Industrial REIT. STAG Industrial is an owner and operator of industrial real estate. It is focused on single-tenant industrial properties and has 390 buildings across 37 states in the United States and went public in 2011. The focus of this REIT on single-tenant properties might create higher volatility in cash flows compared to multi-tenant properties, as the former are either fully occupied or completely vacant. However, STAG Industrial executes a deep quantitative and qualitative analysis on its tenants. As a result, it has incurred credit losses that are less than 0.1% of its revenue since its IPO. As per the latest data, 55% of the tenants are publicly rated, and 29.5% of the tenants are rated investment grade. The company typically does business with established tenants to reduce risk. Like most REITs, STAG Industrial is negatively affected by rising interest rates. As interest rates rise, the yields of REITs become less attractive and their valuation is pressured. Rising interest rates also force REITs to refinance their debt at higher rates when it comes due. REITs, utilities, and MLPs are the most vulnerable securities to rising interest rates. On the other hand, rising interest rates indicate that the economy is strong, and STAG Industrial greatly benefits from a strong economy thanks to the nature of its assets. STAG Industrial continues to grow thanks to favorable economic conditions. In the absence of a recession, this REIT is likely to offer about a 10.4% average annual return over the next 5 years, due to its 5% dividend and 5.4% expected share price appreciation from Sure Dividend. With that said, investors should be wary of heavy dilution due to new share issuances and its vulnerability to a recession. Next up is Global Net Lease REIT. Global Net Lease is a real estate investment trust investing in commercial properties in the US, which represents 56% of its locations, and Europe, 44% of its locations, with an emphasis on sale-leaseback transactions. As of December 31st, 2018, the company owned 342 properties with total square footage of 27.5 million square feet. Office properties accounted for 53% of the company's holdings, with industrial distribution and retail making up the remaining 39% and 8% respectively. Global Net Lease is a $1.4 billion market capitalization business which generated $147 million in adjusted funds from operations last year. While the 11.6% dividend yield and total return potential is attractive to investors, there are a variety of areas where we advocate caution, including the past reverse split, management's potential conflict of interest, a limited history, the high payout ratio, and the company's need to keep issuing more shares. Furthermore, the required return rate for those new shares is quite high to avoid dilution. It will be interesting to see how the company performs in a more challenging economic environment and what the dilutive action may look like. We do note that this is a high-risk security with an elevated chance of a dividend cut during a recession. Next up is Main Street Capital Corporation. Headquartered in Houston, Texas, Main Street Capital Corporation is a business development company that provides long-term debt and equity capital to lower middle market companies and debt capital to middle market companies. Main Street Capital defines lower middle market companies as generally having annual revenues between $10 million and $150 million. The company's investments typically support management buyouts, recapitalizations, growth financings, refinancing, and acquisitions. At the end of 2018, Main Street had an interest in 69 lower middle market companies, 56 middle market companies, and 59 private loan investments. The $2.3 billion market capitalization company generated $157 million in net investment income last year. Main Street Capital Corporation has put together a solid record in the last decade. The company's model is unusual for common equity, but typical of a pass-through entity, paying out all of its earnings and funding growth by issuing shares. This leads to two distinct qualities: an above-average dividend yield and an ever-increasing share count. While this gives us pause in our growth assumptions, the security is still offering a solid yield at a reasonable valuation, and we assume 11.7% total annual return potential from the stock's 6.3% yield and 5.4% expected share price appreciation. Next up is AGNC Investment Corporation. American Capital Agency Corporation, or AGNC, was founded in 2008 and is a mortgage real estate investment trust that invests primarily in agency mortgage-backed securities on a leveraged basis. The firm's asset portfolio is comprised of residential mortgage pass-through securities, collateralized mortgage obligations, and non-agency MBSs. Many of these are guaranteed by government-sponsored enterprises. The majority of AGNC's investments are fixed-rate agency MBSs. Most of these are MBSs with a 30-year maturity period. The counterparties to most of AGNC's assets are located in North America. Counterparties in Europe also represent a significant percentage of the company's total portfolio. AGNC derives nearly all of its revenue in the form of interest income. It currently generates about $229 million in annual revenue and trades with a market capitalization of $9.7 billion. We think investors will experience total annualized returns of about 12.3% per year over the coming half-decade thanks to expected 0.4% annual earnings per share growth and the 11.9% dividend yield. While the stock has exciting total return potential, it remains a high-risk security due to its highly leveraged business model that has high sensitivity to interest rates and the housing market, and the fact that its dividend has seen steady declines over time. We believe that earnings per share will rebound this year due to stable performance in the mortgage markets and low interest rates. However, if it fails to do so, the dividend may have to be cut again, which will significantly reduce our total return projection. Monthly dividend stocks can provide a wonderful and regular stream of passive income. As seen from the list of stocks discussed in this video, there remain some attractive opportunities among this group today, despite rich stock market valuations. However, each one stock comes with significant risks that investors need to consider before deploying their capital into these opportunities. Thank you for watching this video, which explored 5 monthly dividend stocks that you can use to generate passive income from your portfolio today. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.